Every bond is really just a loan in the fancy outfit. In a credit rating, it's an expert agency's best guess at how likely the borrower is to pay that loan back on time. Three big names do most of this work: S&P, Moody's, and Fitch, and they publish their opinions as letter grades. You'll spot them on bond pages, in fund fact sheets, and across the headlines every time someone gets downgraded. So picture one long ladder. At the top, the strongest borrowers on the planet. At the bottom, default. We're going to walk down that ladder, rung by rung. AAA, the top rung. AAA. Moody spells it slightly differently as AAA, but it's the same band. This is the strongest assessed ability to pay debt back on time. You'll see it on top-rated governments and on big supranational issuers like development banks. But here's the catch. Strongest doesn't mean risk-free. A bond still has a market price, and a long-dated AAA bond can absolutely lose value if interest rates jump, even though the credit quality never moved an inch. So when you see AAA, read it as an extremely low chance of a missed payment, not I can never lose money on this. Those are two very different promises. AA, one step down. AA, or AA if you're reading Moody's. The ability to pay is still very high, just a little more exposed when conditions turn bad. The gap from AAA is small, but it's real. In a serious downturn, a AA borrower has a slightly thinner cushion than a AAA one. You'll see this grade on strong national governments and the most solid large companies. And here's the lesson of this rung. A credit rating is a gradation, not a light switch that flips between safe and risky. It moves in shades. Single A. Same letter at every agency, no spelling games here. Still a strong borrower, but one that shows the strain a bit more when the economy turns sour or its own business takes a hit. Solid with a slightly smaller buffer once things stop going its way. It's one of the most common investment grade ratings you'll find on corporate bonds. Each step down this ladder simply trades away a little more resilience. Quietly, gradually, one rung at a time. BBB, the floor of investment grade. BBB. Moody's writes it as BAA. This is the lowest band still treated as investment grade. The borrower has adequate capacity to pay, but it's more sensitive to bad economic conditions than anything above it. Now here's the number actually worth memorizing, the bottom edge, BBB-, or BA3 in Moody's notation. That is the last rung that still counts as investment grade. Those plus and minus signs, they're just finer steps inside a band, not separate kinds of rating, just a finer ruler. And one thing people get wrong, BBB isn't almost junk. It's the floor of the higher quality zone. Which is exactly why downgrade news around here gets nervous in a hurry. The line between investment grade and high yield, this isn't another rung. This is the single most important line drawn across the whole ladder. Drop just one notch, from BBB- down to BB+, or from Baa3 to Ba1, and a bond crosses from investment grade into high yield. A tiny step on paper, big effects in the real world. Funds that are only allowed to hold investment grade may be forced to sell the bond. The extra yield investors demand widens out. The bond can get harder to trade. A bond that falls across this line has a nickname, Fallen Angel. Pretty poetic for finance. That's why this boundary, not any single letter, is the thing that filters, fund rules, and headlines care about the most. BB, first rung of high yield. Below the line now. BB, Moody's BA, the first rung of high yield, also called speculative grade. The borrower faces real uncertainties about what's coming, so investors demand a higher yield to hold the bond. And read that part carefully. The higher yield is compensation for taking on more credit risk. It is not a free bonus sitting on top of a safe bond. This rung is the home of high-yield bond funds and most fallen angel stories. It pays more precisely because more can go wrong. Single B. Step down again. Single B. Same letter at every agency. The picture shifts here. The borrower can still pay, for now, but only as long as favorable conditions keep holding up. If the economy weakens or the business stumbles, the margin for error shrinks fast. So high yield isn't one flat block. There's a real gradation inside it. And single B sits clearly below double B in terms of how much has to keep going right. Triple C and below, close to the edge. Triple C, Ka at Moody's, and everything below it down to default. Here, the story changes. It's no longer how risky is this, it's how close to default is this. At triple C, or Ka, getting paid depends on conditions staying favorable, and the bond is genuinely vulnerable to a missed payment. Lower still, double C, then single C, and you're sitting right at the edge of the cliff. Default itself carries its own labels, and they vary by agency. S&P uses D or SD. Fitch uses D or RD. Moody's bottom is C. Treat those as small agency-specific footnotes, all pointing at the same fact. A required payment was actually missed, or the debt got restructured. One thing worth knowing, though, default doesn't always mean investors walk away with nothing. Some value may be recovered later. But that's an advanced and uncertain story for another day. It's issuer rating versus issue rating. Up until now, that they were covertly in interest the value of issue rating. Now the question changes. What exactly is being rated? Because there are two different things going on. An issuer rating judges the borrower's overall ability to pay its debts. An issue rating judges one specific bond. And those two aren't always the same. Thanks to seniority and collateral, a company's senior secured bond can be rated higher than its subordinated bond. Secured lenders stand at the front of the line if things go wrong. That's why one single company can show several different bond ratings at the same time. And it's exactly why it's worth checking. Does the rating on your screen belong to the company as a whole, or to that exact bond in front of you? Quick footnote on this. If a bond shows NR, that just means no agency has rated it. It doesn't mean the credit is bad, it just means nobody's published an opinion. A rating is not a guarantee and not a yield signal. This is the most important guardrail of all. So plainly, here's what a rating does not tell you. It's an opinion, only that. An opinion about relative credit risk, how likely the borrower is to pay. It does not cover the risk that rising rates push the price down. It does not cover the risk that the bond becomes hard to sell when you actually need to. It does not cover the risk that a currency move quietly eats your return. And it is never, never a buy or sell recommendation. On a bond page, you'll see the rating sitting right next to the yield. Side by side, they look like they belong together. But they answer two completely different questions. The rating asks, how likely am I to get paid? The yield says, how much is the market charging for the risk it sees? A high yield is the price of that risk, not free extra income. In a quick word, since you're listening in English, this is not your personal credit score. A bond rating is an analyst's opinion about a piece of debt, not a number about you as a person. Different worlds entirely. Two more labels you'll spot nearby that aren't ratings at all. An outlook or a watch only signals the likely direction of a possible future change. So outlook negative isn't a downgrade yet. It's a heads up that one might be coming. And the same letters on a national scale only compare borrowers within one single country. So a national scale AAA is not the same animal as a global AAA. Same letters, different ladder entirely.